Today we are analyzing Ingersoll Rand, ticker IR. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. First up, this company has a market cap of $28.1 billion, enterprise of $29.6 billion, so you see about $1.5 billion in net debt on this business. Compared to the overall enterprise value, that's not very significant. It's less than 10%. Machinery industry. They provide mission-critical air, fluid, energy, specialty vehicle, and medical technologies in the United States. So that's a diverse segment. So industrial technologies and services segment, and then a precision and science technologies. So this segment designs, manufactures, markets, services air and gas compression, vacuum and blower products, fluid transfer equipment, power tools, lifting equipment. Looks like you have some brand names here: Ingersoll Rand, Gardner Denver, Nash, Comp Air, Elmo, I can't even pronounce it, Imco Wheaton, and Runtech Systems. So they have the other segment: designs, manufacturers, diaphragm, piston, water-powered peristaltic gear, and pumps. So here's pumps, gas boosters, compression systems. So these are very high-tech machined equipment. Here you can see their brands as well. So they have some brand names to back them up: Air Dimensions, Albin, Aero, Dosichin, Haskell. I don't really recognize these names, but this is definitely a business-to-business type company. They're selling to other businesses, not retail, so that would be one reason why. You can see that they're used in all sorts of industries: medical, life science, industrial, water, wastewater, chemical, energy, foods, basically everything. So these are very probably critical products to the operations of their customers. And they would probably be, since machinery, they're going to be taking some, inputs that are definitely going to be based upon raw materials, steel, stuff like that. And those metals are going to be turned into products that they can probably price decently well. The machinery industry is going to require, strong uptime. You think about a pump or compression system. If that goes down, that can be a big problem for your customers. So they're going to want to pay for reliability. Won't necessarily have to always compete on price. We'll see how that plays out in the rest of that analysis. So return on invested capital chart. We don't have a long history here, but 2015 they lost money, 2016 they lost money, and they lost money in 2020. They've made money for 3 years before losing again. Not very strong returns on invested capital. You see the peak here is 7%, 4% in 2011, 2022. These haven't been the greatest years for in industries, but still not very strong returns on invested capital even in the good years here. Now, return on assets of 0.4%, return on equity 2.1%. So again, very poor returns on these 10-year medians. But let's look at the revenue growth over time here. 2015, you had $2.1 billion in revenue. 2022, you're up to almost $6 billion in revenue. That's pretty strong growth here. You see 22%, 13%. They declined in 2019. They almost doubled in 2020. Very strong growth. It makes me wonder if they had an acquisition here. But overall, the gross profit's grown, has almost doubled and almost tripled basically since 2015. You've more than doubled, almost tripled in revenue since 2015. That's very strong growth. Gross margin has a little bit of operating leverage. You can see they went from 36% to 39%. And the operating profit is up 4x. From $222 million to $879 million. The growth here is simply amazing. And what's strange is they aren't earning the returns on invested capital you would expect in order to justify this sort of growth. I'm a little concerned we're going to see some dilution, but we'll see if that's true when we dive more into the income statement. Let's look at valuation. So here's earnings per share. So our peak earnings is 2022. So we'll use that earnings. We have $1.47 here in earnings. $69 stock price. So yeah, your PE of 40 is pretty accurate. This is definitely an expensive company. Yes, you're growing rapidly, but this is an expensive price on the PE. You can see it's also expensive EV to EBITDA, EBIT, free cash flow. These are very high numbers. A normal high quality business might trade at a PE of 20 or less and be a decent price. At a PE of 40, you're paying a very expensive price. This is a very expensive company. The growth is probably what you're paying for. The market recognizes this growth. If you can triple your revenue in 7 years and you can quadruple your earnings in 7 years, that's a very rapid growth rate and can lead to very strong returns. It's why you would, basically be worth a high PE. It's possible that that's a reasonable PE for a company like this, but it's certainly not a PE I would ever pay. But I have some concerns about the quality of the business based upon this chart. So we're going to have to study the financial statements to learn a little bit more. If you're learning something for this video, if you like my content, hit that like button. Don't forget to subscribe. Let's go to the income statement. So what can we see here? So you see cost of goods sold bouncing around a decent amount. That doesn't, their most margins are pretty stable though, is what we already saw. Okay, so gross profit, tripled from 2015 to trailing 12 months. How did their SG&A did? It did less than triple, so that's where you can see a little bit of that operating leverage. 427 to 1.1 billion is only about a 2.5x. So you triple, only have a 2.5x. You're getting a little bit of operating leverage. Other operating expenses, 130 million to 350 million is less than a triple, so you're going to get a little bit of operating leverage. So that's how it's all going to play out here. Is you're getting operating leverage to turn this operating profit of 220 million into 880 million in profit, and that turns really well. It looks like the trailing 12-month numbers are doing well as in addition. So you're up to 6.4 billion. So you're definitely doing very strong on your growth rates, and that number keeps continuing. Yeah, so they definitely, when did I think the acquisition occurred? Yeah, 2019 to 2020. You see this big jump in revenue, 2 billion to 4 billion. It's definitely an acquisition because you see the big jump in shares outstanding. So they almost doubled their shares outstanding. So yes, it's great that you grew your revenue this fast, but if you grew your shares outstanding that fast too, you're not actually getting the benefit of a shareholder. It's why, despite the fact that your operating profit is up 4x, 5x, you don't see the same sort of results on the bottom line because you've diluted yourself so much. You began the decade at 190 million shares. You end at 410 million shares. That's a more than doubling of your shares outstanding over time, 110%. So yes, you're growing rapidly. You're growing really quick. Your revenue is going up so fast. But because you're having to issue shares in order to do that, it's just not worth the same if they were able to attain that growth without diluting you. So you need to be aware of that when you're analyzing this company. You can't just look and say, hey, look, we went from 2 billion to 4 billion here. It's like, well, you did, but you acquired that. I mean, if you think about it, I was talking about how this amazing growth looks. But from 2015 to 2019, the company's flat. 2.1 billion, 2 billion. They didn't gain anything. They didn't gain any gross profit over this 5-year period. All of the growth came in the last few years. Now, clearly, the acquisition has worked from a growth perspective because now they're growing reliably. But you need to be aware of like organic versus inorganic growth because you don't want to pay up for inorganic growth. You can't rely on that always occurring in the future. Paying up for organic growth can make sense, but this inorganic growth is very, very different. Now, PP&E, you can also see this jump here. You can see this big jump in goodwill and intangibles. This is probably why you're getting poor returns on invested capital. Your actual capital invested in this business is not that high. 650 million PP&E, inventories of 850, so 1.4 billion-ish in actual capital, but then you're earning $1 billion in operating profit. So your returns on your physical capital are very, very good. But there's a lot of intangibles in this business. This is coming from acquisitions. This is coming from money spent in the past that you need to take into account when analyzing the returns to shareholders. The actual returns of the business are very strong. And so to go back to what I was saying here on quality, the returns on invested tangible capital are exceptional. What this is going to be is that you would easily meet my metrics for return on invested capital, return on equity on the tangible assets. This is a high quality business and it is growing rapidly. That's all a good sign. So we can justify it's a high quality business even though it doesn't look like it here because you can see when you look at the balance sheet numbers, you compare them to the income statement, how those good returns are playing out. But it's a little bit harder to analyze that way on this particular company. Now, debt looks like it's about flat, 2.7 billion to 2.7 billion. Cash and equivalents, 1.6 billion. So you see that only $1 billion in net debt. Again, not a very significant amount. One concern I do have is you see pension liabilities here. I really don't like pension liabilities on companies that I buy. I don't want to own companies that have a pension. They can definitely spiral out of control. I'm glad that number is not going up a lot, but it is up a little bit. So I'd want to study the pension. Has it been frozen? What's going on? Because pension liabilities can get out of control if they're not watched carefully. Cash flow statement. Stock-based compensation. I don't know why you have a stock-based compensation in a machining company. I would do away with this completely. I don't like that. It does show that part of the difference here with that is between depreciation is you see 10 straight years of positive cash flow from operations, even though you had some years with losses on the net income line. That's coming from depreciation and amortization. Why is it showing no cash paid for acquisitions? Was this just a complete stock purchase? Let's go to... Yeah, it was just mainly, I guess, mostly stock. So it must have been a merger for Ingersoll Rand. They're not spending a lot of money on PP&E here. Again, that's just supporting what I said before. This is definitely high quality. You're not having to use a lot of capital. You're earning very strong returns on invested capital that this chart doesn't show. The problem for this company, for me, comes down to dilution and price. So the price here, PE of 40, is just excessive. Could they earn it with the sort of growth rate they're seeing, 29%, 14%? These are the growth rates when you're growing in the teens plus, that paying a high PE ratio can work out to you. The problem is, as a value investor, you don't have a margin of safety. If that growth drops, you're going to get punished both on lower growth and loss of your PE ratio. So if the PE goes from 40 to 20, your stock price is going to drop in half. If it goes from 20 to 10, it's going to drop in half again. And so you can get double punished when you pay up for a high price. So I don't like to pay up for a high price because I don't want to be punished on margin contraction, multiple contraction. And so a PE like 40 here is just simply too high for me to consider a company. So they have good growth. Their growth is doing well, at least keeping up with dilution. And they do have a strong, high quality business, but the price is too high. I wouldn't consider a company like this unless the PE was 20 or less. And I want to see a change in the capital allocation. I don't want to see dilution. I don't want to see these big stock mergers. They're very unpredictable to me. It makes it hard for me to predict the future. So for that reason, I'm going to pass on Ingersoll Rand, even though there's some really key things that, if you're an astute investor and you want to do some studying, study their business model, study how they're making those high returns, study their growth. If it can continue in the future, especially if it can do so on an organic basis now, you could be in store for really strong returns if you get it at the right price. I don't think I'm at that price today, so I'm going to pass on Ingersoll Rand. If you enjoyed this video, hit that like button. Don't forget to subscribe, ring the bell. If you want to use this software, quickfs.net, to learn more about this company and other companies, go to the first link in the description below. It is my affiliate link. I can get a commission if you use my affiliate link, free or paid account. Great way to support the channel. It's not going to cost you any extra for using my link, but it's just a way of supporting me, and I hope you'll check out this software. I really enjoy using it. quickfs.net. Thank you for listening, and until next time, stop paying fees, start building wealth.